This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Retail wreck. Will this earnings season be the sector's worst in nearly a decade?
Staying focused, the market's brushed off the firing of the FBI director and stocks are oddly calm. Why? And what moves, if any, should investors like you make?
Modern medicine, how artificial intelligence could one day predict what diseases we might get. Those stories and more tonight on Nightly Business Report for Wednesday, May 10th.
Good evening, everyone, and welcome. The talk in Washington and on Wall Street was about yesterday's firing of FBI Director James Comey. More on that in a moment. But we begin tonight with retail. Some say the industry now faces its biggest challenge since the Great Recession. And as the sector gets set to report earnings, investors are preparing for the worst. We've already seen a growing number of retailers file for bankruptcy, and if the pace keeps up this year, could see the highest number of such filings since 2009. And just today, the teen retailer Abercrombie & Fitch, which has seen its stock fall more than 40% over the past year, is reportedly in merger talks with at least 2 interested buyers. Tomorrow, we may start to see just how much pain the retailers are in when companies like Macy's and Kohl's report their quarterlies. Bob Pisani takes a look at what to expect.
The overall retail picture is looking pretty grim right now. About 20% of all publicly traded retailers are expected to lose money in the first quarter. 20%. 60% will report lower earnings than the same period last year. That's terrible. That would be the worst performance for retailers since the Great Recession. Retailers have reached a tipping point in the last few months, plagued by a number of big problems. For example, more sales are going online, we all know that. And there's a shift to experiences like travel and restaurants over buying apparel. And of course, we have a big oversupply of retail outlets out there. Then, of course, there's Amazon. That's the big elephant. Amazon made up more than 60% of the growth in U.S. online retail sales last year. 60% of the growth. And they're about 27% of the growth in the total retail market. Think about that. One company was a quarter of all the growth that we saw in retail sales last year. How do you compete with that? There is no margin for error because of the pressure Amazon and even Walmart are putting on the businesses in terms of pricing and delivery. Still, a number of retailers are holding up, including the home improvement group. So Home Depot and Lowe's, they're doing well, and some beauty companies are doing well. Ulta is doing well, Coty is doing well, but that's a pretty small group. The typical retailer is down double digits this year. The biggest movers, what else? It's Amazon, it's up 26%, and the other behemoth, Walmart's up about 11%. Tough year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Oliver Chen joins us now to talk more about retail earnings and what he's expecting from some of the big names reporting their results tomorrow. He's the senior retail analyst at Cowen and Company. Oliver, welcome. Nice to have you here.
Thank you for having me.
You know, Bob Pisani kind of set the stage, and it does sound like it's going to be a pretty difficult quarter for many of the retailers. What are you going to be watching for?
Yeah, there is a transformation and a revolution happening in retail. There are 3 main problems. Firstly, physical store traffic. Physical store traffic is declining anywhere from 5 to 6%. Secondly, the rise of online and Amazon. Keep in mind, about 80% of America shops at Amazon, and there's over 50 million Prime members. And thirdly, the consumer transformation taking place. Consumers basically have stores in their phones, and so they have stores in their pockets, so it's really changed a lot of behavior. So what I'm looking for is really more information on the reality of store closures. At Cowen and Company, we think as many as 10 to 20% of these store bases need to have closed their stores. And malls, there's too many malls in America. So about 20% of malls could be repurposed. So that's a very dominant theme that will pervade a lot of the conference calls as well. Physical store traffic's an issue. And the equilibrium point. Online will probably grow from 10 to 15% to 20 or more.
Is there or are there stocks in the retail space that you follow, that you like, that are worth investors' money? Which are they?
Yeah. I would say you're going to go high, go low, go super premium, or go deep value. So we like LVMH, Louis Vuitton, we like Tiffany, we like Sotheby's. or you go for value. We like TJ Maxx, we like Ross, we like Costco. So that's really how the shopper is shopping, high-low, and you want to play this theme about what's un-Amazonable. That's a theme I follow closely, and Amazon is an awesome convenience source, but if you're going to buy a diamond or a $100,000 art piece, you're going to go to the luxury goods, and then if you want goods on sale like a TJ Maxx and Ross, you got to go to those stores to get that discount.
You know, Bob said that experiences are taking the place of regular retail shopping, but I guess you could argue that an LVMH or a Tiffany's, when you go into those places, it's an experience as well as a purchase.
Yeah, it really comes back to brands and running a great brand. And at the pinnacle of luxury, it's about heritage, it's about craftsmanship, it's all underpinned by innovation. So Amazon's a house of brands at the department store, but if you own a great brand like a Vuitton, a Sotheby's, a Tiffany, a Lululemon, that's a powerful resource. So thinking about that is important. Costco, another great retailer, very well-priced items, deep value. So customers always like a bargain. Keep in mind that's another name we like too, because value will always be in style.
On that note, thank you so much, Oliver. Oliver Chen with Cowen and Company.
Investors were watching the fallout from the late-day firing yesterday of former FBI Director James Comey. The big question they have is whether it will impact the Trump administration's economic agenda. John Harwood comes to us from Washington tonight. John, if the dots can be connected, connect them for us. How could this impact the president's push for such things as tax cuts, infrastructure spending, even health care?
The furor surrounding a decision like this, it was the only thing anybody in Washington was paying attention to today and will be for some period of time, prevents Congress from focusing and making tough decisions on policy issues that are difficult already to begin with. Second of all, it puts more pressure on the Republican coalition behind Mr. Trump. They only have 52 votes in the Senate. If you start getting people nervous about associating themselves with his position, either in the House or in the Senate, then it's more difficult. Let me give you one piece of sound that I just, from a conversation this afternoon with Josh Bolton, the former Bush White House chief of staff, now runs the Business Roundtable. It was an informal setting because I was doing it for a speakeasy interview. But here's what he said when I asked him if he was disturbed by what happened with James Comey.
The president has the right, the authority to fire the FBI director, but there will be a lot of turbulence over the timing and the circumstances of this. And so my concern from my vantage point at the Business Roundtable is that that will delay or distract from what should otherwise be a very productive period for legislating and acting on economic policy priorities. I don't think there's reason to doubt about the stability of the rule of law in this country.
So even if there's not a constitutional crisis, which is a prospect being raised by some of the president's strongest critics, this certainly gets in the way, guys.
You know, Mr. Comey is being asked to come testify on Capitol Hill. So once again, that whole story will kind of be resurrected. So given that, how long can investors expect this distraction to last, do you think?
Well, look, I think for some time, because not only do we have an FBI investigation, which will continue with the career professionals and some new head of the FBI, but you've also got the Senate Intelligence Committee investigation. And one of the people who seemed particularly disturbed on the Republican side by what happened yesterday was Richard Burr, who co-chairs that with Mark Warner of Virginia, the Democrat. And Mark Warner said we now have questions about the rule of law. And that is a very major topic to occupy Washington.
All right, John, thank you very much. John Harwood in Washington tonight.
On Wall Street, stocks were oddly calm. You might expect stocks to move on a headline that read, White House fires FBI director, but not today. In fact, it was Disney's results that we reported on yesterday that dragged the blue chip Dow index lower. So here are the closing numbers for you. The Dow Jones Industrial Average lost 32 points to 20,943. The Nasdaq gained 8.5, and the S&P 500 rose more than 2.
So what should you make of today's calm stock market reaction, and what, if anything, does it mean for you and your money? Eric Onnes is president of Titus Wealth Management. He joins us now to discuss. Eric, welcome. Good to have you with us. You saw the stock market barely budge today after the sort of bombshell last night about the firing of FBI Director Comey. But is there the possibility that if the Trump agenda gets stalled, that the market would react?
Hey, Tyler, great question. When you look at what's happening and the noise that's centered around this, frankly, it's just that. It's noise at the moment. How deep it goes, we're gonna have to wait and see. The bigger question is, does it delay some of the tax reform? What's going to happen, and how will that play out, and will it be delayed in some fashion?
Does the economy trump Trump?
Or is the Trump trade over?
Yeah.
That being said, we think that earnings have been good, interest rates are low, money's cheap right now, and companies are hitting new highs every day. So the sentiment seems to be good. The question is, if this is delayed a little bit, or if something larger comes out of it, what happens to the market? And basically, how much of it has been priced in?
Exactly. Now, you like consumer staples and information technology on a pullback at this point, yet we also have very low volatility. The volatility index has been almost at record lows.
Yeah, so when you look at those two, there's two things that we like to look at. One is consumer sentiment, and we see consumer sentiment in the upper 90s, and we see the volatility index sub 10. We're not saying this is going to be a big sell-off, but market corrections do happen. And seasonally, going into May, this is a summer. There's a sell in May and go away that comes up occasionally. So we do want to be aware of that. And the question is how we become a little bit toppy, and if the tax the tax trade gets stretched out,
right,
what does that do to the markets? Mm-hmm. We really haven't seen, when we think about a pullback, January 1 of 16. The S&P was at 2081. 5 weeks later, it was at 1810.
Yes. Eric, thanks for reminding us. That was great. Appreciate it. Eric Onnes with Titus Wealth Management.
Still ahead tonight, why the pressure is mounting on a very visible CEO. Boeing has suspended flight tests of its new 737 MAX jetliners. The aerospace company is citing engine problems. Excuse me, the jet has not yet been delivered to airlines. The first delivery was expected this month, and Boeing says it plans to stick to that schedule. Phil LeBeau is covering the story for us from Chicago. Good to see you tonight, Phil. What does this mean for Boeing, and how unusual is this type of problem so close to delivery?
Whenever you stop flights, it gets a lot of attention because it doesn't happen very often. Look, they're not changing the delivery schedule. If that were to happen, then you would really see the stock taking a hit. I think people are a little cautious right now, but by all indications, we were out there for the first flight of the 737 MAX, and that was in January of last year. By all indications, the first delivery, once they get done with inspecting these engines, will be happening next week. This is a LEAP 1B engine built by GE and its French partner Safran. They noticed a quality control issue. Nothing happened during a flight, so they're going to be inspecting these engines. And again, they expect the first delivery to happen next week. And also keep in mind, Boeing is in the midst of ramping up 737 production later this year from 42 a month to 47 a month. So if that were to change, then we'd have a bigger issue.
This is their key aircraft. Let's switch gears, Phil, and talk about another company you follow, Ford. There are reports over the past couple of days that the CEO, Mr. Field, is coming under pressure from the board to better explain his strategy. The stock is slumping. What do you hear?
Mark Fields is facing pressure, and primarily the pressure comes down to this. They're making huge investments trying to reposition the company for autonomous drive vehicles utilizing future technologies like artificial intelligence. These are big investments that Ford is making. At the same time, they're seeing lower profits, and compounding that is the fact that they're trying to keep up with rivals, old rivals like GM, who are looking at record profits, and new rivals like Tesla. To drive that point home, take a look at shares of Ford and Tesla since Mark Fields became CEO in July of 2014. I mean, you look at this and you would say, wow, Tesla must be having great profits over that time frame. Ford has been profitable, very strong profits, and yet the stock has done nothing under Mark Fields.
Yeah, but is the gain that we've seen in Tesla partly because of the CEO and because of all the different and some would say very sophisticated, very out-of-the-box types of ideas that he has, whereas Mr. Fields is running an old line company that's innovating, certainly, but it's a vastly different type of company than Tesla.
Exactly. It's also a profitable company, unlike Tesla.
Exactly.
And the problem for Mark Fields is he's made these huge investments that he eventually thinks will pay off. And most people believe that they will pay off. The question is when. Will it be in 2 years? Will it be in 5 years? Will it be in 7 years? And how patient do you have to be as an investor? That's the pressure on Ford.
Is Ford the hot brand, or has GM sort of surpassed it? Because, you know, GM touts that they've got lots of models, including their trucks, that are doing very well. And I sense that GM may have a little bit more of a hot factor attached to it.
I would say it has more momentum, partly because it has a younger lineup of vehicles right now, and that is helping General Motors. But really, when you talk about the hot brands out there, look at what's happening in the other company in Detroit that nobody talks about very much, Fiat Chrysler. You've got Jeep and you've got Ram, and those are two of the hottest brands that are out there right now.
Indeed they are. Phil, as always, thanks so much. Phil LeBeau in Chicago.
Toyota issued a downbeat earnings forecast. The largest Japanese automaker said profit for the current year could slide 20%. The company blaming increased spending in the U.S. market and a stronger yen. Now, if that happens, it would be the second straight year of profit decline for Toyota and could crimp investments in new technologies like artificial intelligence and autonomous driving.
Yesterday, we talked about the airlines and that despite all those viral videos, customer satisfaction is rising along with their stock prices. Well, today there was another survey with pretty similar findings. According to J.D. Power, consumer satisfaction is up for the 5th straight year thanks to cheaper airfares, better on-time performance, all-time low bump rates, and less mishandled bags. The survey collected responses from April of last year to March of this year, but that was before the video of the passenger being dragged off that United flight and it surfaced.
Well, Time Inc. cuts its dividend, and that's where we begin tonight's market focus. Following a weak earnings report, the struggling magazine publisher said it was lowering its quarterly dividend to 4 cents a share, down from 19 cents. Print ad revenue, a soft spot for the company, dragging down overall sales more than expected. Time also saw its loss widen, and it missed estimates to boot. Shares fell a whopping 14% on the session to $12.95. Higher labor costs ate into profit at Wendy's, but the fast food chain still managed to post earnings that beat expectations. Same-store sales beat estimates thanks to the popularity of its value meals, but overall revenue fell because the company sold more restaurants to franchisees. Shares rose 5% to $15.87. And Charlie Brown and the gang are heading north as Canada's DHX Media is buying the entertainment division of Iconics brand group for almost $350 million. DHX will now own the rights to the Strawberry Shortcake brand and a controlling stake in the Peanuts franchise. Shares of DHX Media were up more than 5% to $4.60.
Profit at drug maker Mylan rose and topped expectations thanks to strength in that company's overseas markets. Revenue also edged higher but came in a bit shy. The company did reaffirm its guidance for the year. Mylan shares rose fractionally to $38.21. In its first earnings report since going public, Snap posted a less than stellar quarter. After the bell, the social media company reported slowing user growth and revenue that fell short of estimates. Shares initially plummeted in after-hours trading. They also ended the regular session down 1% to $22.98. Under pressure from its investors, Whole Foods named a new CFO and 5 new members to its board of directors. The news followed the company's latest earnings, which were in line with estimates. Whole Foods also raised its quarterly dividend 29% to 18 cents a share and said it was launching a more than $1 billion share buyback. Shares initially rose in after hours but finished the regular day session down 32 cents to 36.25.
The future of medicine. That term might bring up images of wearables or new, more targeted treatments, but there's one thing that could truly revolutionize healthcare more than any other: artificial intelligence. Meg Terrell has tonight's Modern Medicine story.
Already, digital ad technology can predict what we might buy. Soon, artificial intelligence may be able to predict what diseases we could get.
The potential is perhaps the biggest of any type of technology we've ever had in the field of medicine.
It's being worked on by tech giants from Google to IBM to Philips.
So in many of the fields where we are using AI already. In patient monitoring, we can predict hours in advance whether a patient will get a heart attack.
Startups are proliferating as well. Researchers are training computers to analyze information from sensors, images, and language using a technology known as deep learning.
We give it the image and we tell it that, okay, these set of pixels represent cancer, while, these other set of pixels are not cancer. So can you learn how to distinguish between these two automatically?
Without human inputs and with enough data, computers may make connections we're not capable of.
Computing capability can transcend what a human being could ever do in their lifetime, because they can be fed, just millions, hundreds of millions of whatever the topic is of interest.
Joel Dudley's team at Mount Sinai developed a system known as Deep Patient that mines anonymous health information on the millions of people in the hospital's database.
It takes all of that data at a high level and starts recombining it in different ways and saying, are there hidden connections among these data that would allow us to better predict, for example, who's going to get type 2 diabetes.
And that's something that a computer might be able to do that a person couldn't.
Cannot, right.
Many caution, though, it's early days, and the hype around artificial intelligence is significant. Hurdles from access to data to reimbursement to simply understanding how AI works abound. But as investment grows, leaders in the space expect AI to influence the way doctors and consumers think about health. For Nightly Business Report, I'm Meg Terrell.
And coming up, why virtual offices are now a real player in real estate.
Mortgage applications are on the rise. Total volume increased about 2.5% on a seasonally adjusted basis last week from the previous week. And it comes as the buyers complain about high home prices and limited listings. According to the Mortgage Bankers Association, volume is still below year-ago levels because of weaker refinancing.
Anyone with a computer can launch a website and start working from basically anywhere. But for some, where you work is still important. That's why the boom in small business is causing yet another boom in offices. Not real offices, mind you, but virtual ones. Diana Olick reports from New York.
On the 85th floor of One World Trade Center, there are receptionists, offices, conference rooms, and co-working spaces. But it's what's not here, or rather, who is not here, that matters.
What is a virtual office?
Well, a virtual office is really people who are working from home.
Australia-based ServCorp has operations in 24 countries, but entered the U.S. only recently during the recession, when real estate rents slumped. They took space in several prime locations, including One World Trade Center, where they're subleasing both the space and the address.
We've now got 40,000 customers who don't actually even rent any space from us. They can use our space on on a casual basis. They can use the infrastructure that we've got and the technology, the telecommunications technology, so their business is really well represented.
Starting at $250 a month, clients can get the 5-star address, the urban area code, secure email, and a receptionist who answers for their company and can accept real mail or faxes.
It's absolutely marketing. I think that the aim of marketing is to build trust in clients so you can create an environment where they want to buy from you. And really, this is maybe turbocharging that.
Executive office suites have been around for decades, but technology has caused a new boom in small business. Boutique financial firms, PR, marketing, tech, and information services. That's where virtual offices have become a real player in real estate.
Jordan Hamad is CEO of a small tech consulting firm in Oregon, just 7 employees. But you'd never know that from his One World Trade address.
There's a good deal of prestige that comes along with being here. It's the most recognizable address in the world, and so it's great that we can attach the company name to that. And we primarily use it as a marketing mechanism as well as a flexible space to work.
Businesses can pay a little more to have access to co-working space like this, or a lot more to rent an individual office. Competitors like WeWork, Spacious, and Regus also offer flexible and virtual workspaces, but don't go as far with the high-end virtual. ServCorp claims virtual office now accounts for 40% of company revenue.
But you think co-working has peaked already?
Look, I think that there's a mix of space that you need in order to make your business model stack up, and I think it's really about an ecosystem. And what I'm really excited about is I think that virtual office is the next big thing.
The biggest expenses for small businesses are people and rent. The longer they can put off investing in both, the more profitable they'll be. Now that technology allows anyone to be anywhere, at least virtually, it makes sense that wherever you are, you should be at the top. For Nightly Business Report, I'm Diana Olick in New York.
What a view. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Thanks for me as well. Have a great evening, everybody, and we'll see you right back here tomorrow night.